river in the dark, it's raining in the park. But meantime, sound of the river, you stop and you hold everything. A band is blowing Dixie, double fall time. You feel alright when you hear the music ring. Well, now you step inside, but you don't see too many faces. Coming in out of the rain, they hear the jazz go down. Competition in other places. But the horns, they blowing that sound. Way on.
Woo! We are back. Episode 41, the Investment Grade Bitcoin Podcast, True North. Here we go. Let's bring everybody on. We're going to have some fun tonight. We're going to do a crash course in corporate finance. We're going to talk about credit. We're going to talk about risk. We're going to dive through a ton of topics. We have got special guests here tonight. We've got the Bitcoin wizard, Adam Livingston. We've got Tim Kotzman in the flesh, going to come say hi. Grain of Salt just hopped on. We got Ben Workman as usual, and Saylor is going to hit us with a little bit of history tonight. So we're going to have a really good conversation. We're going to talk about quite a few things on the agenda. Let's just go through it. Actually, we'll start with an intro. The intro being, this is True North, the Investment Grade Bitcoin Podcast. If this is your first time listening to this, we talk about everything under the sun, Bitcoin related, Bitcoin finance related, securities. We talk about investments. We talk about capital, collateral, insurance, different marketplaces, and just the everything finance that sits behind the scenes of Bitcoin here and the combination of the two. So it has been evolving quite a bit, and we just take it as it goes every day. We talk about what's happened in the last week, and thanks for being here. Appreciate the time. So the agenda for today, typically we are going to walk through the STR MicroStrategy and the strategy preferred equities and an update on all of the statistics. We're going to get into what is money, what is credit, what is risk. Bitcoin treasury companies, can multiple exist? This is a common thread. This is a really hot topic at the moment, and just thinking about who's going to succeed here in this marketplace. Dominant empires, what does a dominant empire look like? The debasement trade and the dollar abroad. Grain of Salt was just in South America, so we're going to get some unique perspectives on that. We have a new segment that we're starting every week called the Bad Bond of the Week. I think this will be extended. It'll be good. We'll talk about risk and think about different frameworks of who's holding some of these things and how that might change over time. And then AI and Cisco, getting an update on the Silicon Valley business model. I think we'll also hit on energy. I think energy is a really huge topic at the moment, and we'll kind of weaves through this entire thing. So yeah, there's so much going on here. We are frequently talking about a marketplace that is really operating in dog years. About 7 years of typical life is happening in 1 year, and everything is moving so quickly. And we're excited to talk about it and get through it. So without further ado, I will pop over to, actually, we've got Tim Kotzman.
Hey, how's it going? I'm still alive.
You're still alive. You're not digital. I mean, we could play you if you want, and just get into it, or we could get it in the flesh in real life.
Ladies
and gentlemen,
see if
Tim still got it. We don't know, so we're going to test him out again today. See if
I don't even know. Ladies and gentlemen, what you're about to hear may be amazing, but it is not financial advice. It's for entertainment and informational and entertainment purposes only. Back to Jeff, Adam Livingston, Saylor, Ben, and Grain of Salt.
Thank you.
I got to ask you, when you're out in the streets of New York City harassing people about Bitcoin on your show, do you have to give them the disclaimer before you get rolling there, or are you just diving right in?
I'm diving right in, but it usually comes up at some point, or maybe they should be telling me that. I mean, I don't know if you saw episode 2, but there's guys in Times Square that are taking options trading courses. I mean, New York is, a bunch of hustlers out here.
You got to do taxis too. Just hop in a bunch of different taxis and talk to them, see what you'll get a lot of XRP. Most of the taxis I'm in, the guys are talking about XRP. It just kind of goes to show you.
Okay. Yeah. I think Adrian and I are going to do a few, try to shoot some stuff while we're in Santa Monica later next week. So that could be interesting.
The options traders are they're shadier than the chess players. You got to watch out.
Also, warm welcome to Adam Livingston, the Bitcoin wizard. You have officially surpassed everybody in follower count on this entire stream. And congratulations, the flippening has occurred, and it is well-deserved because the amount of content you're putting out is absolutely absurd. Your AI conversations are incredibly refined, and great work. So excited to have you here today.
Really appreciate that. This is a full circle moment for me because you guys radicalized me. So thank you so much. I couldn't have done it without you. Thank you.
Absolutely. Okay, let's get into it. Let's jump into statistics, which we talk about every week, and we just take a look at the health of MSTR, which is the, what do you want to call him, a 1,000-pound gorilla in the scene. We are going to share my screen here.
The 1080-pound gorilla.
1080-pound gorilla, exactly. Long 1080s. Okay, MSTR financial leverage. So we show this every week. We've got a few columns here. This is different timelines in each different column. So focus your attention on what is now column BN, which is Bitcoin held. Strategy holds 640,000 Bitcoin and 31 Bitcoin. Bitcoin price as of today, 122,000-ish. MSTR price is about $331. Bitcoin assets, they've got $78.3 billion of assets on balance sheet, $8.2 billion of debt, $6.5 billion of preferred stock. So your net capital sitting on balance sheet, if you just take assets minus the debt, is $70 billion, which is an absolute ton of money. And you've also got another figure here, which is the net capital, which is the $70 billion number, minus 4 years of the preferred dividend outstanding. So you've got $67 billion in net capital when you factor in at least 4 years of dividends on the balance sheet. Then I've got this liability to asset ratio, which is just showing the liabilities, assuming a pure notional value of the debt plus the preferred. You've got an 18.9% leverage ratio and a debt coverage multiple, or a BTC rating, of 5.3. I think this will be pretty close to what is on Strategy's website. So when you think about, what kind of event would take a company like this down that has leverage of this size and scale, it sounds like a lot on a nominal basis, but on a percentage basis, it's really not that much. The price of Bitcoin would need to be below $23,166 for the assets held on balance sheet to be worth less than the notional debt outstanding. That is, I think, incredibly unlikely at this point. And many people on the screen would be selling everything in their entire world to buy Bitcoin at those prices, or something else drastic maybe breaks Bitcoin. I think that's a very low tail probability. So the price of Bitcoin would need to go down about 81% and stay there for an extended period of time for this to even start to become an issue. The next thing, obviously, hop in there, Mike.
Yeah, I just want to chime in real fast. So I've talked about this before, but you said it's 18.9% is the current debt.
Leverage.
Yeah, right there.
Yep.
That's a leverage.
Yep.
That means they have the reverse. That means they have approximately 81% left in assets. And what I said before about a month ago is that when anybody goes to buy a house, if you put down 20%, it doesn't matter whether the house is $100,000 or $1 million. You put down $200,000 and you're 5-to-1 leveraged. It's the exact opposite of what people are comfortable doing. This is a volatile asset. We all know that, but this is very low leverage. So when you hear in mainstream media, hey, Saylor is leveraged up to the gills, or he's got huge amounts of leverage, it's not. The notional amount is billions of dollars, like Jeff just said, but the actual leverage ratio is the exact opposite of what you do when you buy your house. Yep. And that's the interesting part.
Bingo. Exactly. The other column I've got here is just if you were to take out the $3 billion of convertible debt that's outstanding, that's currently trading really deep in the money effectively as equity. So that actually drops the leverage ratio even more. So on an as if pro forma leverage basis, the liability ratio is around 15%, so even less. So the price of Bitcoin would need to go down even further. And obviously, the price of MSTR has been down in the last couple of weeks. We've gotten a lot of crap saying that we don't talk about it. So obviously, the price is down. I can't control the stock. The stock does whatever it does, and that's just the way it goes. So, but like the reason we do this every week is to talk about the fundamentals. Like just because the stock goes down doesn't mean that they're not making money. Like the company makes money. Like if the price of the equity goes down, it almost doesn't matter. If the price of Bitcoin is going higher, the company's getting stronger, like regardless of what the equity does. So there's a lot of, craziness, obviously short reports and a lot of energy being like thrown around saying these things are dead. But the company's like getting like incrementally stronger as the price of Bitcoin goes up, which makes the short thesis even just more insane as you start to play this out and think about the game theory down the road, like the long term. Sure, are there shiny things in the market that people are chasing right now? Absolutely. We just saw an energy stock with iron go from $5 to $60 in like 3 weeks or 4 weeks or something like that. Yeah, there's a lot of shiny things in the market that people are chasing, and if people make money on those, awesome. We talk about this because like this is the big story. This is the huge story. This company has an order of magnitude greater than the next closest company of the best capital on the planet. What does that look like down the road? We're here to unpack that, and that's what we're here to talk about today. So the fundamentals, when you look at the fundamentals, the Bitcoin per share, or the Bitcoin exposure per share, is increasing drastically year over year. Like, why do you buy this over IBIT? Your Bitcoin per share, your Bitcoin exposure per share is increasing drastically over time, right? Just from 2023, you've got increase of 74% and then increase of 26%. That is more. That's more Bitcoin. That's as simple as that. You're yielding Bitcoin by operating and financing different operations. Anybody else have anything to add there?
Well, maybe I'm jumping ahead because I'm sure you've got this graphic somewhere, but aren't they closing in on really jumping up the Treasury list?
Oh, yeah.
Aren't they in striking distance of being the number 2, the second largest Treasury?
I thought you did it. Somebody did a post on that. What is it?
I did.
What was the number? 140,000?
152,000, and they have the second largest corporate treasury in the world behind Berkshire Hathaway.
Now, I did a post about a month ago, which Saylor liked. It was a big day for me, so I'll congratulate myself. And what I said is that if you adjust the balance sheet based upon the market cap of the company, they have the largest treasury, the largest balance sheet in relationship to the market cap, even including Berkshire Hathaway. So that's the number 1 on the list. So if you reframe it that way as a percentage of the market cap, they're way ahead of Berkshire Hathaway already. And so with this, getting into second place is unprecedented.
Yeah, this is massive. I think one thing to point out that kind of stood out to me a little bit when thinking through this is if you go look at these companies, their assets held, the number is very different. So if you go on macro trends or anywhere where you scrape any of the public data, the assets held is actually maybe significantly larger for some of these companies, but they show cash and short-term investments. Why? Because Bitcoin is effectively a cash/short-term investment. It's liquid 24/7, 365. You can sell Bitcoin at any point in time. It's the most liquid market in the world. Whereas these other companies that are carrying these assets on their balance sheet might be, a $1 billion campus in Silicon Valley that is illiquid, right? Who's going to buy that on the other side of the trade? Like it's an asset sitting there, but it's very illiquid. So I think that's helpful when you think about the context of these corporate treasuries. Like, what's the value of this? Well, the value of having liquid assets is you can protect your company against risk, any risk that happens at any point in time, because you have a liquid asset. So good point, Ben.
Well, it's just such a massive jump, right? What started as this, darling of the .com bubble, and now all of a sudden they're shooting up the list with companies that are perceived for the value that they're holding, right? These large value organizations. And now one's within striking distance of being in the top 2, only behind Berkshire, who is the poster child for holding capital. And this is all made possible by Bitcoin and the power of corporate balance sheets. Now, People are going to argue this, and it's going to happen forever. There's never going to be a consensus on this, where sentiment changes when the price goes down like this, particularly when it grinds down like this. When you get into the bull market, everyone's completely hyper-focused on getting as much Bitcoin exposure behind those shares as they possibly can, increasing that exposure that they have to the asset that they believe is perpetually going up and to the right? The ultimate carry trade. It's the debasement trade here. But then when it grinds to the side, then the focus is only on the price of the equity, the common stock. Now, reality is there's both there. And everybody who's investing in these, ultimately, the focus is on the price of the common equity, right? I think everyone here would agree with that. But what you're trying to focus on, and I think this is something that a lot of people miss, is when you're putting a management team in place and making them responsible for executing a long-term strategy. The KPIs that you put in place, the reason for the KPIs is those are what are going to guide all of the action along the way. So if their strategy has been, we're going to focus on implementing methods where we can increase the Bitcoin exposure to each of our shares, they're going to hyper focus on that metric and execute whether the markets are good or the markets are bad, because it's about years and decades. It's not about weeks and months. And what they're looking at is that they're building up this asset backing in the one asset that's meant to combat one of the only certainties you can almost look at out there in the world, which is the debasement of fiat currencies. That isn't stopping. If you look at the state of the world and go, man, these currencies are about to get stable, I'd love to see the charts you're seeing, because that is just not a reality. You saw the notes that came out from the Fed. You got more rate cuts that seem to be on the way, but they're worried about the injection of inflation that's going to come along with that. Like, the macro picture is pointing towards additional liquidity coming in, and they're going to try to grow their way out of this, and they're going to have to fuel that somehow. And so if you don't see them being able to put the lid on that in the next 1 year, 2 year, 3 year, 5 year time frame, this is a long game, and you want as much exposure to the one asset with a truly fixed supply that you can get. And that means you've got years of this company taking the opportunity to build that value under your shares for you. And when you take the long-term approach to this, you can feel pretty comfortable, but it doesn't mean, and I want to be clear about this, it doesn't mean that there are no bad entry points into these investments, right? That's a reality of all investments that you make. You can be directionally correct and you can time it incredibly wrong. That's real, right? And I know we're all mega bulls and we're looking at this strategy for what it means for 5 years and 10 years, and we're nothing but bullish on that. But you do have to find the right entry points, and you're looking for the best risk reward that you can possibly get. Now, most people right now are fleeing out of the treasury space. You're seeing sentiment getting absolutely clobbered. It's coming down, and this is happening right at the moment where most of these plays are so de-risked that it's hard to see that much more downside to them. So even companies, when they're trading below their net asset value, everyone else thinks that that's a death blow. I don't think that it is, because the incentive structures shift over time. And what I think a lot of people are going to figure out is that if you've got the ability to enter one of these plays where you've got a corporation and a corporate balance sheet that can do these things that are going to help to accrete that Bitcoin exposure, and now you're able to pick it up for 80 cents on the dollar from the Bitcoin they already hold. Imagine what you were going to do is go buy IBIT, right? You were going to go get just Bitcoin exposure. You just want Bitcoin beta exposure, which people that don't know what beta exposure means, it just means it should move like Bitcoin, right? It should track Bitcoin. If that was all you were looking for, but now you can go into an investment where you've got a discount of 20 or even 25% on some of these to Bitcoin, if your only thesis in that is that if the bull market takes off in Q4, right, say we rip for the next 3 months, which historically has been the case, if the only outcome you think could be achieved on that is that maybe it'll trade for just the base value of its assets at some point during that time, you'll have greatly outperformed Bitcoin during that time period. So there's going to be a point where people start to see these opportunities and start changing their allocations, because now you've got the ability to outperform and you're completely de-risked. And if you don't believe that the business is going to be completely insolvent and die off, or they're not completely burning cash constantly and you're worried about that drain, you're in an incredibly strong position to now benefit into the future of all accretion that comes into those shares.
Yep.
There's because you do have to be able to pick those equities and you have to find them. And that's not easy. That's the diligence part of investing, right? There's no edge without diligence. If you're not out doing due diligence, if you're not out reading SEC filings and getting the details most people aren't willing to get, you're going to miss the opportunities. And that's why, you know, for us, this has been such a fun journey, because you get so deep down that rabbit hole that you start to spot what opportunity looks like in this space. Because it's hard for a lot of people because it's so new. This doesn't have a decade-long track record yet. We've got 6 months of a lot of companies in the space.
Ben, you've fast forwarded into part 3 of the of the agenda here. I'm gonna have to put you on pause here for a minute.
Yeah.
Well,
go ahead.
I'll jump in there.
Go ahead, Soleil.
I got to disagree with you, Jeff, with what you said about MSTR's price being down. And people can say that this is copium or whatever, but when should you enter into a position, right? If you think Bitcoin's going up on a 4-year cycle, then you're going to want to jump into that position, beginning of January before the halving. And so I think a fair measurement starts there, January 1st of 2024. And if you take a look at Bitcoin, it's up like 3x from that point. And Strategy is up currently 5x from that point. And, you know, people are measuring it from the blow off top in November, but that was like a 9x return compared to Bitcoin. That was completely unreasonable. That is, you can't expect Strategy to trade 9x to Bitcoin in perpetuity. So you can't be mad that a stock that has a meteoric rise has a correction like every other stock that ever has a meteoric rise. It happens every time. So if your starting point is an unrealistic blow off top, you're going to be real disappointed.
Yeah. 100%. And on top of that, they raised like $42 billion in like, I don't know, 60 days, 90 days, something like that. It's just an incredible amount of capital raised, and they raised the floor, right? They raised the floor. They helped bring the price of Bitcoin up. They raised the floor of the 1x mNAV price, which I posted about this previously. And Adam, please jump in there at any point.
Absolutely.
But I posted about this, just comparing very similarly. Soleil, right? 12/30/23, the Bitcoin price 42,000. The 10/7/25 price is 121,000. So Bitcoin price gone up 190%. The 1x mNAV. So if you were to compare the 1x mNAV price, let's call this the floor. If you believe 1x mNAV was the floor, the 1x mNAV price went from $52 to $271. So it's up 422%. And that's like really simple math, right? The actual price has gone from $69 to $329. But really, this is the whole thesis. Like this line right here is the entire thesis. This is why we're here. They're raising the floor forever because Bitcoin is the best capital ever. That's it. Go ahead, Adam. Come in. Hop in.
Yeah, I agree that the floor is being raised. That is why we're all here. And, you know, I was just going to make a quick comment on what Ben was saying, is that right now you're seeing some of these companies, they're trading at a 0.7, 0.8, 0.9 mNAV. And the reality is that some of those have a lot of debt on the balance sheet where they're capitalized with a lot of debt. So they're incredibly well positioned to really perform well in the next 3 months when we could see a significant Bitcoin bull rally. And, you know, the sentiment is so bad right now when you simply point out the mathematical reality of how well some of these companies are positioned to benefit from a Bitcoin rally. You know, you get accused of getting paid. You get accused of getting paid by David Bailey, and the sentiment's just really awful out there. So yeah, I don't know. I think it's totally unfounded. I think Soleil makes a great point. You know, the floor is getting raised, guys. And I think that a lot of the sentiment just really is irrational, and we get to take advantage of that.
Yeah.
But I think when you're looking at these companies, one thing people really do need to look at is the leverage. If you think we're going into a Bitcoin bull run here for Q4, you want a company that's got leverage. You want them to be levered long Bitcoin during that time period. If you're about to go into the most explosive time in the Bitcoin cycle, you want the companies that have leverage. And I think that there's been this shift where most of the capital that's been raised in the space probably over the last, month or two has really been equity capital. And that's going to need to change here. And I think that for a lot of these companies, they're going to have to start positioning themselves and putting some leverage on to make sure that when you get this run, that you're getting that benefit from it, right? What if we do go up into a super cycle, right? And this just grinds up into the right. That might actually be max pain for a lot of people. And if that were to happen, that could be really painful if you didn't get leverage on before the most explosive part of that bull run happened. So I would just, when people are looking at these companies, that is one of the differentiating factors. And I think it's one of the things that strategy is really focusing on at the moment. They've gotten so big that putting on enough leverage is very difficult. And that's what they're trying to work on. They're trying to scale these prefs. And now that, stretch has been bumping up against par again, and it's getting into the range where they can actually go and use the ATM on that. We'll see if they raised any capital when they launched it on Robinhood, and it actually hit the $100 peg briefly there and stayed above 99 for a while. But their key focus right now is got to be getting leverage on, because they want to be that levered long Bitcoin proxy in the market. And with the speed at which they've been able to grow with equity capital, it's kind of left them a little imbalanced, particularly with a lot of the converts in the money. So I'm expecting, them to have a real focus on hitting those prefs as hard as they can. So if that demand and that liquidity is starting to show up in those products, I'm expecting to see them accelerate the pace at which they're collecting that capital now, and probably laying off the delevering tools.
100%.
I mean, the common ATM is a delevering tool, right? It builds that balance sheet capacity to allow you to put more leverage on. But at this point in time, I think for strategy, that pivot towards becoming more levered than they are today. I mean, was it 15% or something around there, Jeff, that you said, if you accounted for the converts that are deep in the money already?
Yep, 15%. Yep.
And I think that they probably want that up around 30. So,
yeah,
I
get
think
it higher.
That's good.
And that kind of gets into this whole conversation of credit. Also, real quick, if you were racist in the comments, you were getting kicked out. You're gone, like immediately. Like there's zero tolerance for that. So just FYI. Back to leverage. 100% agree. Like these companies, they can just wait, right? And a lot of these companies that have come out through these pipe deals have already taken on leverage before they even went public. So they literally, this is like strategy in 2020 if they were a private company and did a deal, and then they put on the leverage as a private company and then came to the market, and it takes a while. Like that's got to go through, and then eventually these companies that have taken on leverage have more capacity to take on additional leverage. What does that look like? It's tough to say. If it's convertible debt, then all of that capital is cleared, and now you could have 100% capacity to go take on new forms of leverage. So it's really just it's a time thing. It's these companies have time.
And I saw a few questions about why is Saylor waiting to put leverage on. Let me assure you, he's not. Right? They're trying to put leverage on right now. But what you got to realize with these products is these products are still so new. We've all been digesting them now for months and figuring out what they are and the value proposition and what it means for Bitcoin to have this high compound annual growth rate and gives the company the ability to pay a high coupon. But you have to go and source that demand. And these are pretty large products relative to the exposure that they're getting, right? So when you've got billions of dollars, if you're sourcing that through retail channels, that's going to be pretty difficult to ramp up. And a lot of the institutional capital will really, truly be unlocked when they've got the capability to get ratings. So part of it is just an education game in the market.
We should talk credit. We should talk credit.
All right, sorry.
We should talk credit. We should talk credit. This is what we're here for. We're here to talk credit. Okay, so actually, real quick, we hit the update. We hit a little bit on Bitcoin treasury companies, and maybe we come back to it. But I wanted to start with this. What is money? What is credit? What is risk? And I think thinking about all of these three things in concert are very important, right? There's been this huge push to figure out what is money, right? Safety wrote a book about it, the Bitcoin Standard, Saylor series, What is Money podcast with Robert Breedlove. There's been a lot of focus on this, and people had to learn about what is money, right? Step one, once you have the money, what do you do with the money? Step two, credit. And then part of that is credit and risk. So that's where we're at in this evolution. And that's where this thing needs to go. That's the natural evolution of this entire space. So I asked the guys on the screen today to think about the word credit. Like, what does credit mean to you? Like, how does it impact your day-to-day life today? And what does it look like? Because this entire landscape is likely going to get changed and shift up a little bit. So Adam, I know you've talked a lot about this. You've done a lot of digging into the space. I'm going to start with you, and maybe we'll pass it over to Mike and start to think about it.
Yeah, it's an interesting question, the philosophical aspect of money and valuation itself, right? And right now, I just think that we're watching the credit markets slowly realize that trust itself is a counterparty risk, but the thermodynamics of Bitcoin is not. And I think that the fact of the matter is that Bitcoin is the apex collateral because everything else is literally just a claim on entropy. So if you really think of the implications of this, any industry that relies on trust-based collateral will be consumed by truth-based collateral. And you just think of all the industries that really run on collateral, whether it's bonds, credit, banking, insurance, energy, sovereign finance, real estate, whatever it is, you realize that Bitcoin is just going to start to slowly touch everything and then just take over because it is the least risky asset. And, you know, the classic debate is that Bitcoin is competing against gold, against the dollar. But I think really on a bigger picture, what Bitcoin treasury companies and maybe more specifically strategy have really illuminated is that Bitcoin is competing against kind of what the default architecture of trust is within our civilization. And this is why everyone's brains are being so broken and understanding Bitcoin's relationship to markets is tough because there's so much of that unraveling to do. It's just a lot of deprogramming on a very fundamental level. So if money equals like crystallized time and energy, you know, your effort, your labor, then credit is something like belief in future productivity, and risk is entropy that just leaks through that trust. So I think on a broad scale, I think everyone should think of credit as being civilization's shared hallucination that tomorrow will exist. And I don't know, I just think that this is proven because we all know that fiat credit literally created the illusion of growth through debt expansion. That's the position that we're in. So it's literally proven.
Yeah.
Every single debt-based empire that has been built on borrowed time, you know, and Bitcoin is where time finally collects, and whoever has the most Bitcoin collects the most. So I think it's a very interesting philosophical discussion.
Totally.
But in a nutshell, that's kind of what I think about Bitcoin, credit, money in a nutshell.
Mass solution is an Instaclip. Make it happen.
Instaclip. The clipping team is watching this. Please clip that one. There you go. Please. It really all comes down to trust, right? And so when I think of credit, I think of just seeing credit throughout my life. I go to the restaurant and I use a credit card. I have a mortgage. Or somebody gets an auto loan, or you've got these other different types of credit systems that are just really pervasive and in everyday life. Why does that structure exist? That structure exists as a trust system to provide, you know, the ability to interact within society based on like how time, energy, like and money is flowing throughout a society. So really this concept of credit and money is like so incredibly intertwined with like the entire ledger system. You can see how there's a natural transition here into the credit landscape, and Bitcoin's going to work its way in there. Go ahead. Anybody else? Other thoughts? I've got some data information. Grain, hop in there.
Sure. So I think all of us know there's basically three forms of credit that most people are used to. One form of credit is, I mean, you could use a debit card for things, or you can use a credit card. And so you go make a bunch of purchases. You get paid twice a month or once a month or weekly, whatever it is. You make your purchases. If you're responsible, then you pay off the bill in total at the end of a month. That's 1 month credit. You need a way to get to work. Well, what can you do? You could walk to work for 5 years, save $500 a month, and then go buy a car for cash. Or you could buy a reasonable car, put down a reasonable down payment, only walk to work for 2 years, and then buy the car on credit, and then you pay it off while you're driving it for the next 3 or 5 years. That's a midterm credit. And then the longer term credit that Jeff just talked about is a house. You can go live in a tent, and you could do that, save up your money or live at home until you have enough money and go buy a house for cash. Or you could buy the house on credit, and the collateral is the house itself. And I was thinking about what I said about Saylor. If he only has 15% debt and the rest is equity, he bought a house with 85% down. So he has very little leverage. Most people do the reverse. You put down 20% or less than 20% to go buy the house. So we're all used to this, but sometimes his numbers are just bigger. So I think we all use this every day. I posted a video from Ray Dalio.
Yep, that's in the chat.
Yeah, how the economic machine works. That if you were to go to any I pick on Ivy League all the time, econ professors, none of the econ professors could explain how the economy works in 30 minutes like Ray Dalio's video does. It's got almost 500 million views. It's 11 years old. Watch the video. It explains credit. And the benefit for this is that it makes the economy, because you're buying more cars because you could buy them on credit, that allows more people to work in the factories, and your economy grows. And so in America, we have the FICO, credit reports. Literally, they're called credit reports. And if you have good credit, they let you borrow more money, and then you can get a better car. Now, if you take this the wrong way and you buy things that you cannot afford, then you have problems. And so that becomes a personal responsibility piece. So credit is the bedrock. And in the US, we have these, like I said, credit reports, which allow you to borrow money. And the people that hate credit reports are the people with bad credit.
Yeah. And the amount of credit that you can go get is actually pretty insane. I don't know. I think I've got I used to game the credit card system, right? So you get one, you sign up, you get the points, you do all the things. And that was just a thing in traditional finance. It's like what you did. And at one point, I think I had like $500,000 of credit limit. I'm like, this is insane. And I can't believe I was able to rack all of this up. And it's just a mathematical number of trust based on, the way I've interacted in society. So it's like this construct that exists everywhere. And Mike, to your point, you've got revolving credit, installment credit, open credit, different designs of different credit systems. And there are people that are taking the risk on the other side of that trade, right? So anytime you open a bank account or a credit card, you're the JP Morgan, when I go put in my application, they're taking the credit risk behind the scenes, but they've got all these assets that sit behind it. So if I, default, they're like, all right, it's, they're taking that risk that's built into their entire calculation. And that's why the interest rates change and are associated with it.
But by the way, anybody that goes to buy a house gets to play econ professor. What do I mean? You could buy a house with a 30-year fixed mortgage, or what they'll make you an offer and say, you know what? We'll give you an ARM, an adjustable rate with a 5-year lot, a 5 and 2. The first 5 years you have a lower rate, but after 5 years it resets. So you're making a bet and thinking, I'm going to take it with a lower interest rate, betting that interest rates will be lower in 5 years. Otherwise, if it's a 5 and 2 or a 5 and 1, it will reset every year or every 2 years after that. And so you have to think about where that can you refinance? Did you pay down more debt on that house? And so, excuse me. So you have these choices that you can make. And this is all common. This has all been available for 30 years. And so you have to be responsible with it.
Yep. And there's a couple other things here, and when we get into the bad bond section, we'll talk through why this is important. But secured credit, right? So secured credit is a loan that's backed by the collateral that's put up against it. So when you go get a house, if you don't pay, if you default on your house, on your mortgage, they take your house. Then you have unsecured credit, which is no collateral, which is more typical like a credit card or something, which is more risk for the lender. If you default, they can't really do anything. So different forms of risk, and that's all a mathematical construct and a mathematical calculation. And I wanted to bring this up because this is a website. This is called what is this called? This is Household Debt Center for Microeconomic Data. You've got non-housing debt balance, total debt balance, and then the percent of balance that's 90 days delinquent. And this is a really interesting website just to see how corporate or how personal credit, household credit is changing over time. So you could kind of get a glimpse into like the health of the system based on how like the credit profile of the world is kind of shifting and changing. So I thought this one was pretty fascinating. Percent of balance 90 days delinquent. And, you know, the reason I'm showing this is like we're all trying to put this together in real time of like all of these other things that are happening in the marketplace, trying to see through the mud, really. But one thing I found that was interesting here is that household mortgage balances, percent of balance that's 90 days more delinquent, is actually really near an all-time low compared to like going back to 2004. But the other forms of credit, like credit card credit, is kind of nearing 2008-ish all-time highs. You've got other credit is nearing 2009 all-time highs, 2010 all-time highs. Auto loans ticking up, student rates or student loans obviously, you know, rocketing here as well after the Biden era. After the Biden era there. So it's just an interesting perspective how these forms of credit are kind of shifting and changing, and the health of these different systems.
Just seems like the incentive structures are really warped in society when you see those graphs going up and to the right in the last few years. It's almost like we're living with broken money and people can't plan for tomorrow. Really sad image, but yeah, you make a great point, Jeff.
Yeah. So, you know, the first thing I thought about too, it was a sad image. I even wrote that here in my my Excel. My gut reaction was I felt bad about society and like looking at every single one of these. Like the total debt balance of non-housing debt is rising. The spread between the two, between housing debt and non-housing debt, is actually rising pretty drastically, which is an interesting perspective. Non-housing debt balance, again, as the money supply increases, like these debt balances are ballooning and inflating these credit balances, which is again another interesting perspective. But my secondary reaction I had is that, holy shit, somebody else is on the other side of this trade. And like, what does that look like? What does that look like? And what is the what's the downside? And if you're really interested in credit, actually, I'm going to do a little plug for this. There's this like an hour and a half video here, Debt, the First 5,000 Years by David Graeber. It talks about the history of debt. It's like a quick hour and a half on this like 400-page book he put together. Totally worth the time. But the interesting thing I was thinking about here is this loss of access to credit. So what happens if people aren't able to access this credit anymore? Like if this problem exacerbates and there's no like break in the system, what is the break in the system? Is it that people can't get mortgages? Is it that people can't get credit cards? Like, is it that these finance companies that used to be able to provide all this credit, like have no capacity to provide credit anymore? What does that look like? And how does this whole system begin to like reshape itself and change? And one thing I looked at was these mortgage rates, and I wanted to see how they moved in concert with interest rates. And one thing I noticed here is going over the right-hand side. So on the left-hand side, this is the 30-year mortgages in the green, the 15-year mortgages in the blue. And on the right-hand side, I did a little transparent image here, and I overlaid the Fed funds rate. And you can see some correlation to the Fed funds rate. But one thing that was most interesting is when the Fed funds rate came down in September, there was this blip down in mortgage rates, but then it ripped higher. Like after rates went down, it ripped right back higher to, I don't know where it was at, like something around like 6%. And rates have come down again, and the mortgage rates have come down. But the real question is like, what happens? Is there a disconnect there between like interest rates dropping and like the risk of these things actually staying high, like the credit risk of these things staying high, and the market changing? And that's what I'm trying to think through and kind of react on a bit.
So I'll make a comment about this. So look, I think with people that are listening to this that are smart enough to understand what's going on is that you assume that you own a house and it's not paid off. You have a choice. Let's assume your house is going up in value. Pick an amount. Let's say it's 4 or 5% a year. But if Bitcoin has a CAGR of 30% or let's say the CAGR is only 20% on Bitcoin, but your house is only going up by 5%. It would make sense for you to buy more of the faster appreciating asset than to build up more credit by paying off your house, building equity faster in that, because this other asset is going up faster than by paying it down over here. And that's your choice. And if you have a low interest rate, and I'm well aware that mortgages are declining balances and most of the money goes to interest in the beginning, but you have to think about, where do you see yourself in 5 years? Or if a Bitcoin halving is every 4 years, where do you see yourself in 8 years? And from that perspective, do you want to buy things that go up faster? You know, it's not an all or nothing. Split it up and do that. If you have a great job and this is not financial advice, but you could think of it like it's risk-free. Just pay off your house. If your house payment's $3,000 a month and you pay off your house, you don't have that expense anymore. But your house is only going to go up at whatever percent, 5%. And if that's what makes you happy, do that.
Yeah.
What we're doing here, I'll wrap up 1 second. What we're doing here with Bitcoin Treasury companies, specifically with strategy, is we're saying, look, it could take on leverage in order to buy Bitcoin to get a better return over a set number of years. And so either you buy Bitcoin, you buy some of strategy, and then it makes more money over time.
What I think the true distinction that I'm really trying to point out here is that there's a bunch of really bad credit out in the market. And if you hold the best form of collateral, you will have the best credit in the market. That's it. And so that's the way I'm thinking about this. So if you're like, all right, well, I wanted to lay out the personal debt landscape so people can see, like, this is the personal credit landscape, but that same construct exists in the corporate bond landscape, in the corporate credit landscape. And now you've got a company that's got, some of the best collateral on the planet, and they've got an order of magnitude more than everybody else. And all these other companies that are holding this really, really, really good collateral, you have a really good credit quality. The market just hasn't recognized it yet. Like, everybody here agrees, like, your credit quality is insanely good, but the market just doesn't believe it yet. And so my campaign that I've kind of been on recently is this, like, risk is completely mispriced globally everywhere. And it's so mispriced, it doesn't feel mispriced because it's so mispriced. And that's this kind of recognize this risk landscape that I'm trying to, like, unpack and dive into different places here. But
yeah, if you hold Bitcoin, your FICO score should be a perfect 850. Period.
It should be, because a Bitcoin is a Bitcoin.
Imagine you go to buy a house and you put up some Bitcoin as collateral, and the collateral is going up in value faster than what you're borrowing to buy. Like, you should be able to put like 0 down, and they just like, sure, no problem.
Yeah.
Here's the money.
Exactly. And it's just crazy. Like, all these loans that have come out where you can post your Bitcoin as collateral, like, the terms are so horrible. They're
terrible.
They're just so insanely horrible. I can't even believe they exist, because you could just pull the collateral. Like, they've got 25% liquidation. Like, the risk on the other side of those transactions is pretty much zero. If you see one Bitcoin as one Bitcoin, which is just crazy that those are the terms. Like, that's where the market's at. But I want to get Adam in here, because the people want to rant. You got some like some excited fans in the audience.
Yeah, I can go on a quick rant. I totally agree with the thesis that risk is mispriced. When you just look at the universe of comparable assets, like, you look at investment grade bonds that are 2x collateralized, and you have Strife at an 8x. It just begs the question, how over collateralized does this thing have to be before the market starts to really notice these things? Mm-hmm. And they are, obviously, when you're raising billions of dollars, you're raising billions of dollars. But it just feels that, like, the market is still totally not understanding how incredible these products are. And you just look at, like, the analog between, like, a stride and a stretch 2 versus, like, the normal collateralization of those buckets. It's night and day difference. And you just wonder, how long is that risk got to be mispriced? It starts to get frustrating a little bit, but like you guys said, these are so new. We're so early. It's really tough to just, to even predict when they're really going to start to catch on, even though they already are. It's an interesting question.
Yeah, by the time they catch on, the price is going to be much, much higher.
Yep.
I mean, what a lot of people overlook and so banking was the first industry that I worked in. One of the things people overlook when it comes to Bitcoin is, from the underwriter perspective, you're no longer underwriting the individual at all. You're only underwriting the asset, right? It's asset-backed lending is effectively what Bitcoin is. So even when you get a house, you would think that's effectively asset-backed lending as well, right? You've got one asset and you've got one liability against it, and they're securing it based on the value of the house, but they're not. Because in that instance, they're also underwriting your own personal cash flows, and they want to know what else they can come and take in the event that you default and you've got a shortfall on it. So they're underwriting the individual, and there's also a lot of cost and time that goes into underwriting the individual. That's the complex part. So for people right now, and I think that this is a part of the value for people holding spot Bitcoin themselves and actually having access to this, is your cost to capital for you personally in the future is going to be very low. And while they're still high, they're not quite, I used to always say they were in the loan shark range, basically. If you wanted to borrow against your Bitcoin, it was 16 to 18%, not that long ago. You're starting to see that come down pretty quickly. And I think a part of that was you needed to build up the bid underneath the asset, right? They needed to know that there truly was deep liquidity out there for this asset in the event they had to liquidate, so that there was no, liquidation cascade risk out there that they couldn't figure out, how to price. And now you're seeing it come down where even on, I think, Coinbase as their borrowing platform, and it's weird because it goes into a stable coin and all this, but I think that lending rate now is like 7.5 at the moment. And so obviously in that arrangement, you're, giving up your custody and doing a lot of those things. But when you're stockpiling one asset, I can't think of an asset that in the future is going to be more valuable to borrow against, because this is the cleanest transaction you can possibly hope for as an underwriter.
100%.
To be fair to the Bitcoin loan sharks, if they understand Bitcoin and they can just get a 30% return every year, they kind of have to charge a boatload to even make it worth their while, because they should just buy Bitcoin with it.
Bingo.
So, eventually maybe those numbers will come down as Bitcoin's CAGR comes down, and it'll all get easier to do.
So what you're saying is we need lenders that don't believe in Bitcoin as much.
Yes.
Yeah.
That's the problem. That's the problem with this entire industry. When
Find a sucker.
When I left,
Too deep in belief.
When I left reinsurance and I started working in this area full time, the first thing I noticed is oh my God, there's nobody dumb enough here to lend fiat dollars that doesn't believe in Bitcoin, is willing to give me a good rate for the risk. So it's almost a lost cause, because it's so much better to take the other side of the trade all the time, 100% of the time. And so that I understand why that market is not incredibly deep. So it's you got to think about, okay, let's think about the other side of it, which is what Saylor has done in terms of equitizing it, right? This is equity credit, not debt credit. It's flipped the script upside down and gone the other way. I'll give you credit instead of I'll take credit, I'll give you credit. And that's really blown people's brains here. They've got to work on business plans and revenue and all this stuff. It's well, this is a business plan. Strategy is a credit company. They issue credit. Very similar to how an insurance company issues insurance. Very similar. And, I want to walk through this because a lot of people don't understand how insurance works. And I didn't until I worked in it for a long time. But there's this concept of gross written premium and gross earned premium for insurance companies. It's an accounting mechanism. So when they write a policy, when you issue a policy and you get paid that premium in the door on day one, you actually earn out that premium over time, over the life of the policy. So you can't account for actually having the gain on that entire premium that you bring in the door until the policy is over. So you earn out over a period of time, and it's an accounting mechanism. And I think the world could start looking at strategy very similar from an opposite perspective, because you're taking an investment in the door and you have a liability over time, but it's declining over time. So that there's a life of of the policy and like an effective duration such that, you can take that into consideration, like a gross written investment and a gross earned investment, which can be thought of as revenue. And I think this is kind of where this industry is going in a different direction. What do you guys think? It's a little weird. It's Strategy is a credit company, not an insurance company. They're a credit company.
I'm going to take a little bit different of a view of it. I think that sometimes people conflate what Saylor did. What Saylor did was made a bunch of prefs that pay either 10% or 8%, a coupon that comes out either on a yearly and stretch on a monthly. That was not designed for Bitcoiners. It was designed for the bond market. It was designed for people that are risk averse, don't want the volatility, just want to get this. So he created that. Now, where it becomes interesting to someone like me, a Bitcoiner, is that when you could buy enough of it to get paid in perpetuity, an amount that you never have to sell, for me, that becomes compelling for me to sell MSTR shares, pay taxes on that, then buy enough of the prefs in order to give me an income that I can live on in perpetuity. So that for a Bitcoiner becomes exciting, but I wouldn't sell all, I would sell some. Excuse me.
Because the credit quality is so good.
Right, because like what we've been saying nonstop, he's only 15% levered, or he bought a house with 85% down. So from that perspective, he can always pay that. I'm not going to live in perpetuity. So it's an easy math to do. So with that, Adam, jump in. Give us your rant.
I have the rants later on in the show during Soleil's section.
Adam, we just need you on call, like at all times. You just like rant on call, please. The concept.
We need to record a rant. We can just play it every time we're on an episode.
Adam, with the Bitcoin.
I have no shortage of those, man.
Record a rant. If we think Bitcoin's going to gold parity, right, 20 plus trillion, which I think, I don't know, it's like 27.5 trillion as of today. That's like, you're right. Bitcoin goes to $1.2 million. Strategy's balance sheet goes from $80 billion to $900 billion incredibly quickly. There's literally not another company on the planet that has that much cash or capital. So there, again, credit quality is going like literally through the roof. We're talking about 850 credit scores, Soleil. It's like 1080 credit scores. We're going like the credit scores are going higher. Everything's going higher. And that concept is just vastly misunderstood.
There's no frame of reference for it.
There
it's
isn't.
Just total uncharted territory. You can't expect like anybody to have a proper understanding of it. That's just the difficult part. Right. That's why you're called True North.
Right. Yeah. It's like we keep coming back to it. It's like this is it's hard to conceive because it has never existed before that a company has like this much money and is issuing an investment instrument, a credit investment instrument. It's like never existed before.
What if Bitcoin goes to $1 million and you see the value of that Bitcoin NAV on Strategy's balance sheet and you get so ridiculously over collateralized and you hit a ceiling where you can't issue everything? That's just it starts to boggle the mind a little bit, like how over collateralized, how good of yields do we have to pay before people catch on? And we're just going to have these questions answered in due time, but it's a fascinating thought experiment.
And this is where like it all connects to risk too. Because you have to look at like the entire risk landscape, because like this, everything is risk. Every investment on the planet is risk. Equity is risk. Bond is risk. Credit cards are risk. Mortgage is a risk. The real estate's a risk. It's all like, that's why Saylor says Bitcoin is money. Everything else is credit. JP Morgan said gold is money. Everything else is credit. That's like literally because everything is credit and risk. They're like completely intertwined. So you've got to look at the entire risk landscape and compare the risk everywhere. And like, that's one of the reasons I left the reinsurance world. I was like, the risk here, the amount of money people are getting paid to take on this risk is just so stupidly small. It's not like I'm never going to make a ton of money here ever. So like I needed to go somewhere else. And it was very clear Bitcoin made the most sense. Little did I know it was going to be so freaking correlated to like insurance and like risk and credit landscape. I had literally no idea. I was like, I just want to work in Bitcoin. But now I'm making these realizations that like, this is why I was gravitated to it naturally, because this entire risk landscape is just completely off. When you look at things through a Bitcoin lens, it's off. So I think we need to go into the bad bond segment. We could just keep chatting as we're chatting, but I've got a new intro jingle into bad bonds here. Oh, come on. Maybe I don't. Maybe the jingle comes on at some point, but it's not right now. Okay, bad bonds. We'll get into it. So while I share my screen here, no, I'm pretty bummed about that. We'll get the jingle. The jingle will come up. We'll get it. Okay, U.S. corporate bond market evolution. So this is how bonds have shifted over time, just from a ratings perspective. So this is going like worst on the top, and this is kind of hard to see. This is in perplexity, and I wish the lines could be a little bit better. But what this is showing is that AAA bonds are going down. So the amount of like very high investment grade bonds are going down over time, down into the right. Number of unrated and high yield bonds is increasing. So basically, this is indicating that since 2015, more risk has been shifted into the U.S. corporate bond market, and that entire landscape is changing. Oh man. Go ahead. You guys have anything else to say here? And I'm going to try to pull this.
I think that when you talk about bad bonds, I think the interesting part is there's something called junk bonds. I mean, literally, they're called junk bonds. And the quick 1 minute history lesson.
Ladies and gentlemen, what you're about to hear may be amazing, but it is not.
It's amazing every time.
It's amazing every time.
Ladies and
no, that doesn't work either. Let's see if this works. That doesn't work either. Okay. Sorry.
Yeah. So Jeff, just a quick 30-second history lesson. So the reason why the mafia was building out Las Vegas, because you had to use cash because the banks wouldn't loan money. And so then if you watch the movie Casino at the very end, what you then realize what happened is, how's this related to bonds? I'm going on some stupid rant. Well, when Michael Milliken came out with junk bonds, I'm going to build a casino that's going to have a volcano in the front of it that explodes. And people are going to come here and gamble and lose money. And it's going to take whatever amount, hundreds of millions of dollars to build it. It'll take 3 years to build it. Then we have to convince people to fly to Las Vegas. That was the start of the junk bond business with Steve Wynn. Maybe you heard of him. To quote Ryan McGinnis, right? Maybe you heard of Steve Wynn. And so what happened was they used junk bonds to build out Las Vegas. And so how are you going to borrow money in order to build something? It's going to take 3 years before somebody ever comes in there to lose money at the casino. And think about, how do you figure out how much you're going to make? And so that's what they're called, junk bonds. And then we have credit grade bonds, which are decaying all the time. Why are they decaying? I think you were talking about Ford Motor Company. You build a factory, it's 50, 60 years later, it's on the Superfund site. They can't clean it up because it's so expensive. So what do? You put GM into bankruptcy, wipe out the shareholders, and you start over again.
Bingo.
Bingo. And so then you have GM number 2.
Yep.
Because they could not pay to figure out that they polluted all the plants. Look it up.
Yep.
So you don't want to hold a bond on something, on a factory, even if it was good for 80 years, if they're polluting the ground. So Bitcoin, what does it cost to store it? You put it in the cold storage, the storage is pretty much zero. It never needs a new roof, never needs capital upgrades, never needs OSHA, checks. You don't have to worry about people getting run over by a robot. It's so much easier. Why don't I like Amazon stock? Because they have 1 million employees.
That's right.
I'd rather have a company that has a lot less employees because they're less likely to get hurt. My rant's over. I'm not as good as Adam Livingston.
It's all good. I'm gonna try to do my jingle one more time, and if it's Tim, then it's Tim, and if not, hopefully it works. But anyway, we're gonna give it a run.
Bad bonds, what you gonna do? What you gonna do when Bitcoin come for you? Bad bonds, yields falling through. Stretch, strike, stride, and strife coming. Oh. Digital credit, don't miss. Oh. Blaze coupons legit.
Who did that?
All
Who did
right.
that as well as my edit? That's what I
That
want
is
to know.
awesome.
The production is just taking a step up, guys.
Yes, it's we're the team, the crew is working hard. Real quick, shout out to the team. The team is working incredibly hard behind the scenes. We got somebody that made a jingle, somebody that made the video, and we're just going to keep playing it through every time we do the new segment. So
I have a question here. How long did it take you to do that, from time of conception to getting it done?
Justin sent it over this morning in like, I don't know how long it took him. Somebody tweeted about it and he had it done within an hour. And then our team made a video and they had it done within an hour.
Okay.
And
So anybody working in a corporate job, you'd have to go get a budget. Then you'd have to do a wireframe, and then you'd have to do storyboards, and then you'd have to have a committee to see if it makes sense. And then basically about 3 months later, after you go through 50 permutations and you miss the whole opportunity, you'd spend $100,000 to make a 30-second clip.
yeah,
So this is the new world, guys. Congratulations. I loved it.
We've got enough.
we've got a Justin, somebody made the jingle, then we got a team that made the video. And I was incredibly impressed. I was showing my wife.
Yeah.
I was like, look at this. They made this today.
We just do things up in here.
We just do things, and AI is incredible. Maybe we'll talk about that a little bit more with energy later. But okay, thank you for the rant, the detour rant grain to get me to the segment, and that got the technical difficulties fixed. But yes, I wanted to talk about Ford Motor because I think this is an interesting. This is an interesting story. Maybe I'll try to put everybody down below. I'm hidden, but that is okay. And please, anybody jump in at any point. So I've just got a bunch of research that I pulled together here on one Excel sheet. But I'm going to start with one thing that I found pretty interesting, which is why the strategy credit instruments are so appealing, is if you look at corporate bond liquidity versus their credit spreads. Let me just throw you guys on the side so people can see this here. So if you look at corporate bond liquidity versus their credit spreads, this is mapped into different buckets. So you've got a high credit quality over here in the green, over on the left-hand side. You can see they're significantly more liquid. You've got this line here that's showing you the average. The medium credit quality instruments are significantly less liquid, and the lowest credit quality instruments are the least liquid. So in the event of anything remotely bad happening, if you needed to offload any of these things, there's just not a ton of buyers on the other side of it that want to take on that specific risk. So if you get locked into like a 30-year bond somewhere or 20-year bond or somewhere, you may have a really hard time. You might lose your principal, one, but you might have a really hard time of just unloading it. It might just literally go to zero. And I think that relative risk that you're taking for that duration is really curious, and I think it's worth looking into everywhere. So that's the point of starting to look into some of these instruments.
Liquidity is huge, Jeff. Liquidity is massive. Like, I'm sorry, but I was just looking into Hertz, the car rental company's bonds, and I was thinking, like, if you see COVID on the cusp, if you see a virus coming that's going to just wreak havoc on the economy, how do you get out of your position? Liquidity is massive.
Yeah, and Adam, I think you mentioned this previously in a message to me. Right, the Hertz had bonds that went bust before COVID, or like right after COVID, right?
2 months after. That's correct.
So they issued bonds right before COVID, and then all of a sudden, 0 people rented cars. So you're sitting there holding this like instrument that you think is just going to pay you steady stream of income, and you're like, cool, I get my 6%, like my pension's fine, and all of a sudden, nope, that isn't worth anything anymore. Actually, like the company's bankrupt because they literally aren't bringing any revenue in the door because nobody's renting cars. That's called a black swan event, but
it's physical risk.
That is risk. Like that's risk that is difficult to quantify. And there's significantly more types of that risk all over the place. But I think the other crazier part is that somebody doubled down. Like they issued more, right? This is the 2029 bond that we talked about last week. And I think this was issued in like 2024 or 2023. So somebody signed on to it and it's still paying, 10%. So you're thinking like, okay, well, what if robo taxis take off here?
Well, the age of disruption is going to change these products forever, right? The pace at which these company business models get attacked now, you have to imagine that at some point that's going to have to get priced into this. You can no longer take a 30-year outlook on nearly any industry out there. They're all turning over, right? Technology's speeding up so quickly. There's so many more tools at people's disposal. Companies are entering that are leaner, that don't have decades of overhead built up in them. I mean, Mike has talked a few times about being in the corporate world and all the employees and why he wouldn't invest in Amazon. If you've ever gone and worked in one of these corporate environments, you understand the bloat that builds up over decades of operating a business. There's so many roles in there. You're walking around going, what do you even do all day? And now that these other companies are coming in, you can be disrupted in a moment's notice. It happens so fast. And one of the best examples of that was even when you had OpenAI kind of emerging, and then what was it, DeepSeek, that popped up all of a sudden, and all of a sudden it seemed like even the leading AI tool was about to be disrupted. Now it wasn't, right? And there was all kinds of shenanigans going on. But it shows you that even the companies that are doing the disruption are not immune from this, because that is the pace at which technology is evolving. So to go and take on the risk of 30, 40, 50 years with no liquidity to exit out of that position, and you're just tying yourself to this company, I don't know that you can consider many of those money good over the long period. I'm pretty firm you can't.
Yeah.
Based on what we've seen. Nokia was killing it. They had the indestructible phone. Everyone loved playing Snake on that phone. They didn't need to change anything. They were just going to keep pumping those phones out. And then one day you started to be able to watch videos on your phone. They were gone, right? That's what it takes. Not much.
Jeff,
Yeah,
I don't want to hijack your section, but I really want to touch on something because you posted about this. You posted recently about a Target Corporation bond. And I previously worked at Target. I was a director at Target Corporation. Don't come from a glamorous industry where I spent a lot of time just operationalizing like crazy, trying to squeeze the last pennies out of every single dollar, very low margin business. And I was just seeing tremendous risk every single day. The company, we erased $100 billion of market cap in 2 years. We were literally worth 1/3 of what we were after 2 years of getting killed by Walmart and Amazon.
Mm-hmm.
And, this is a company on the precipice of the AI revolution that we just cannot pivot to find a way to survive. And then you posted about their bonds. I'm like, exactly. This is why I was screaming from the inside of why we should just take our billions of dollars and buy Bitcoin. And, I'm just looked at like I have two heads, but sorry for the rant, guys, but it's very relatable right now. There's tremendous risk in physical operating companies. So many of them are zombies that have trouble surviving. And, it's a new term of junk bond. It's a new kind of junk bond, I guess.
Yeah. It would go ahead, Sully.
Yeah, I was going to say, and where do you put disruption risk on your spreadsheet? Because, going back to Ford, I mean, Tesla is dominating the EV space. They're the only ones that make money. And even with the EV tax credit going away, the only risk for Tesla is that it eats into their profit margins. But every single other EV maker loses money every time they sell an EV. So now they're just losing more money. So it hurts Tesla's competition more than it hurts Tesla. And, Ford could be bankrupt in 10 years because of disruption. And what are their bonds worth at that point?
100%.
I want to
100%.
Yeah, I want to chime in here for a second.
Hit it.
So I'm so old that I've been through multiple black swan events, right? The internet bubble crash, Y2K. We won't go back to the 90s. Then you have the 2008, 2009 financial crisis. Then you have 2020 COVID. Everybody's like, oh, black swan events. They happen all the time. Then a super tanker gets caught sideways in the Suez Canal or frickin', and then another one hits a bridge 2 weeks later. And, so when it comes to black swan events, what I could tell you this is they're miserable when they happen. And the people that get hurt, with that is absolutely horrible. But with that, every time they're over, what do? They do the same thing, lower interest rates, print money, and then the asset holders make more money and it goes on. So every time there's a black swan event and then Ben's chiming in, oh, what was it? DeepSeek, the Chinese all of a sudden make a software version that eliminates the need for NVIDIA. Well, that just happened in April. But NVIDIA now is a 4.13 or whatever the number is, $1 trillion company, and it adds $1 trillion in value. But I don't know, that was a black swan event that lasted, what, 6 weeks? And people were like, oh, it's all over with NVIDIA. Maybe they should have bought NVIDIA on the dip, buy low, sell high. I mean, so I've been through this so many times before. The other thing I noticed that you saw on Ford was that they had a bond that goes out to 2097.
Yeah.
Right. I want to tell you something. I gotta go back for something because this is how old I am. So before there was an iPhone, when you would rent a car, you'd have a paper map and you'd fly to some city you'd never been before, right? You get a rental car and then you're driving around to figure out where you're going. You print out your stupid maps on MapQuest off of Yahoo, and you can't figure out where you are. And then you got to get back to the airport, fill the car up with gas so they don't charge you $7 a gallon, because you're not getting reimbursed for that by the cheap person in accounting. God forbid you miss your flight. So then you drive all the way back to the airport. Then a few years later, they come out with Garmin comes out with these GPSs, and they charge you $12 a day to rent that. Of course, you take that because you can't get lost, right? So you're doing that. Then they invent the iPhone and puts out Garmin. But now when I go on a business trip, right, I use Uber probably 30-40% of the time. I'm going to fly to Santa Monica for the event. I have to get from LAX to Santa Monica for Fred's event, doing a plug for him, right? Bitcoin Alpha. I'm taking Uber. It's probably going to be some guy that's going to pick me up in a Tesla Model 3 or Model S, which is better than some crappy taxi I would have gotten, 5 years ago. So I'm driving in a better car and I'm using this app. And then I have an American Express Platinum card, so I get $15 free every month, right? And it's like my life is better because I have a built-in GPS on it. Everything has gotten better. Technology's gotten better. And that's the way the world is.
Yeah.
And so how does this relate? I don't want to be in a company that's getting destroyed by Soleil said it. Where do you put in technological risk into the calculation on something that goes out 30 years?
When technology is accelerating at a pace literally never seen before.
It is. And by the way, on Uber, I've got 5 different choices, right?
Yeah. I see the videos of those Tesla factories too. And it's like the robots that are picking up these like huge chunks of metal and like putting them together. And it's like pretty insane how far ahead they are on robotics too. But I'm just going to pull this up, this Ford, just to put it in perspective, because a lot of people don't know this, but it's actually incredibly difficult to identify the capital stack of companies. Like I've got a Bloomberg terminal here, and even going through the Bloomberg terminal, I was like working on ChatGPT for hours, like trying to like wrap my head around who gets what in the event of liquidation. And the capital stack, I think it's opaque on purpose. So when you actually look at all of these companies that have these really opaque capital stacks, and you look at Strategy that has got a website that shows like, here's our exact capital stack and we're not hiding anything from you, like it's 100% right here. It's so easy to appreciate. Now, this is senior unsecured bonds for Ford. There's 77.5 billion of outstanding bonds. And I just started scrolling. Like you could scroll here for a while. You could see all these issuances, right? You got 4 million, 1.8 million. Well, that's 4 million, 1.8 million, 1.5 billion, 1.3 billion, 16 million, 16 million. And you look at the maturity of some of these, you think like 2046. Like that makes me scratch my head. You look over at the yield, 2046 paying 6.6567%. And you're like, oh my God, that's 21 years out. And it's only paying me 6.6%. Like what can happen in 21 years based on like with these cars? Like is Ford going to be around? And
No.
One person that sold it and one person that bought it, and they both had the same reaction, which was, this isn't going to be my problem.
Yeah, it's just like the Ford probably sold it and they're like, I can't believe I'm selling this right now. And the person that probably bought this was like, I can't believe I could get this. But it's totally insane that somebody's holding that piece of paper. And then I started looking Go ahead. Yeah.
By the way, everybody knows about the 2038 Unix time problem. Right? Everybody knows this, right?
What is this?
Well, Well, they had the problem with the size of the dates that went into the older systems for the Y2K problem. But the Unix systems have the same problem in 2038. So there's existential risk that occurs in systems in the future.
Okay.
And
Yeah.
so
Yeah.
when you look at something that's 10 years after this, what happens to those systems if they can't be updated? Whether it's cars or, it's not only these bonds or producing the cars, it's the amount of employees, it's the capital purchases, it's the factories,
Yep.
it's the pollution that goes into producing this versus something like Bitcoin, which is virtually zero in order to store.
Bingo.
That's the fundamental difference here. And can you go to the other one that's 2097? You scroll, it was in the screenshot.
Oh yeah, was it in the screenshot here?
Yeah, it was. Yeah, it was like in the lower left-hand corner. I just saw it. It just said it was. I think it's right there.
This
on
one.
one
Yeah,
of these
yeah, this
graphs.
one. Yeah, the 5/15/2097, 500 million. It's 500 million with a
Well,
2090.
I mean, when something goes out basically 100 years, it's almost in perpetuity, right? I mean, that's like a pretty long duration bond in my view.
Yeah. Yeah, and there's only 142 million of it outstanding. But that being said, like, what's the liquidity of this thing? How does that work? Does it just do they just buy it back in the open market, or like when they want to retire it? I don't know. The whole thing was a bit strange, and it was a bit strange in just scrolling the capital stack, and I was like, oh my god, look at all the debt, look at all the paper here. There's just paper everywhere. There's so much paper, and then people are like, nobody's going to buy the strategy products. I'm like, Ford has $70 billion of paper outstanding with like a 5.6% interest rate. Like, are you kidding me? Like, there's so much like appetite for this paper, this credit. This is one company that we think has massive disruption on the horizon in the auto market, and like a challenging business model, to be honest. Like, you look at so Ford has $37 billion of cash, $88 billion of debt. So their net assets, minus their liabilities, about $45 billion. So debt to equity is roughly 196%. Debt to liquid assets about 238%. Relative to MSTR, you look at their debt to equity is 23%, and debt to liquid assets is 19%. So that's tricky. That's a bit strange. Now, one thing that shout out FMT, he keeps me honest here. I posted about this yesterday. Sneak preview of this week's bad bond, Ford Motor Company. And FMT brought up a lot of that debt is non-recourse to the parent. Same for GM. So I'm like, okay, non-recourse. What does that mean? And like we reviewed earlier, non-recourse meaning it doesn't have a claim on any of the assets or the collateral of the parent company. And my first response was like, okay, cool. So Ford issued this paper and they're actually not taking on a ton of risk. And I looked up about 60 or 70% of the debt is non-recourse, meaning they can't go chase the assets, which at first makes me feel a little bit more comfortable that Ford might exist for a little bit longer. But the second order effect in thinking through that is that, oh my God, somebody's holding 60% of these $80 billion of debt that has no recourse. It has no recourse. Like you can't even go chase the assets. Like what?
So it's backed by air.
It's backed by air, dude. It's backed by air. Mike, you're on
Handshakes and hugs.
Yep.
And so, yeah,
Wait
I
a
mean,
second.
and if Bitcoin is the disruptor, then strategies preferreds are backed by the assets that is doing the disrupting, not the one that can be disrupted. And that's everything.
Yes.
I start to look at all these companies through the friction lens to the end consumer, right? Because when you're seeing all this disruption happening out there in the market, anything, and I found this with myself, like there was a point in time where I actually started noticing this, where smaller and smaller inconveniences would stop me from doing something, right? So for instance, having to get in my car, drive to the store to go pick something up that I don't really need right now. Well, I can just order it and it'll show up at my doorstep, right? Same thing with a company like Ford. You know, they've got this whole dealer model out there where you've got to go do one of the least favorite things on earth, except for people like Mike, maybe, because he's made it an extreme sport, which is going and buying a car and having to go through the headaches of, dealing with that whole dealership model and go out and test drive. Whereas Tesla, you go online, you put $500 down, they tell you when you can come get your car. You don't have to deal with any of the headaches of feeling like you're getting screwed. None of that. And so you can look at all of these products that same way. I think that's ultimately going to be an issue for banks. When people start looking at Bitcoin as being the money, and now you look at a different model where you're holding Bitcoin as effectively your savings. But if you want something with a return that's still got the security and the liquidity behind it, you go to the products like Stretch and Strife, where you've got the liquidity to get your capital back immediately, but you're getting a higher rate than you're getting at the bank. Traditionally, to go get a higher interest rate at a bank, you got to go tie up your capital in something like a CD or something that's got a maturity where you can't actually access the principal of it, but you're taking the friction out of that process now and still getting the yields that you want to get. And I think that's a really powerful transformation that's happening, because now you have no friction with accessing your own capital. It's sitting in Bitcoin. You've got total control over being able to access your own capital. If you need the cash reserves to be able to live your life and generate some returns and generate some income out of it, you've now got the securities and the equities that are out there that you can tap into at much higher rates, more than double the rates that you're going to get at a bank. And there's just no friction in that process anymore, hardly. So it's come completely back to your control. I don't have to go to the bank and ask them to give me my money, right? I want $20,000. Will you please give it to me? Like, no, I'm just going to go take it. It's my money. I've already got a handle on it. So when you view it through friction, this is really going to start applying pressure to the banking model over time. I don't want to hold anything long-term in US dollars. So my savings account has completely converted to Bitcoin. I'm going to store it in the asset that's not being devalued beyond the rate that I'm getting. And if I need an account that's like a checking, where I need the liquidity and I still want to be earning a higher yield than the rate of inflation, and quite frankly, getting average returns of the S&P 500 along the way, pretty good, I'm going to go to these preferred equities. And there's an education ramp here that is going to need to take place, but it becomes a powerful combination once you finally reach that. Now, it's not going to be reality for everybody, right? We all live in a world where you are saving and you're not doing the paycheck to paycheck thing. And, that's the reality a lot of people are seeing. And I think that was illustrated in some of those earlier charts you showed, Jeff, with that non-mortgage debt really ramping up, which is going to include things like credit cards and personal loans and all that kind of stuff. So it is pretty dire out there. But what you need to realize is, for people that are early to this process, or that are young, or that are just starting out their careers, if you start going up the education curve on how money actually works and finding the right solutions to protect yourselves, the compounding of making that change early and the impact it has later in your life is absolutely massive.
Huge.
So I want to make a quick comment, and again, about Ford. So Ford versus MSTR. Can you go back to the So one of the things that I said before, one of the metrics that they do is like revenue per employee, or we could do it as a balance sheet for net, for employee. Ford has 171,000 employees. Strategy has 1,300. There's an order of 100x more employees.
2 orders of magnitude.
Yeah.
Oh my God.
It's 100x difference. So if you do that, if you do the calculation right now of the balance sheet per employee, and this was known back in the old days of the internet bubble, Cisco, I remember, had revenue of $3 million per employee. That was a sales metric. And so this metric is used in order to figure out which companies have more drag on them. And now it's manufacturing, but Saylor was talking about this, and Jeff was, if you have automated the production in these facilities, you become much more efficient for a variety of reasons. OSHA reasons, you don't have insurance. And so there's a back end expense on the employees. So you capitalize the production. So the numbers are kind of small. What does it come out? What's the difference?
Yeah. So Strategy has $40.8 million of net assets per employee, and Ford has 343,000 of net assets per employee.
My work is done. I should get off the call right now.
Every Strategy employee could lose a briefcase full of cash on their lunch break and still provide more profit than Ford can.
Absolutely. Looking at the forward net, I looked at the forward net income too, because I went full analyst mode on this because, why not? Last year, so this is the last 3 quarters in a row of net income. They went 4.1 billion, 3.8 billion. This is the last 3 years in a row. 4.1 billion, 3.8 billion, 3.1 billion of net income. So like that's not a great story. I think it's pretty clear that these other like car companies are winning. I personally am never going to buy a Ford. And you start to look at the debt and their ability to repay the debt. Their net income, so I took the net income average was about 5.2 billion compared to Strategy's net income average over the last 5 years. I think is technically around 5 billion if you factor in FASB fair value accounting, which is pretty crazy. They're pretty similar. But the years of coverage over and above the net, the debt lasts the cash. So how much debt do you have less the cash? Their years of coverage is 9.7. So basically, if they had their average net income, they would be able to cover their debt after their cash for 9 years, basically. And Strategy's the inverse, because they have more money than they do debt. Like they have more net money on their balance sheet than they do debt.
So this is funny. Today there was literally a news story that there was an aluminum plant's fire. So Ford's F-150 trucks are going to take a huge $1 billion production hit. That happened today.
No way.
So yeah. So think of this. The bond buyer's thesis, the bond buyer of this, their thesis is, please let an indebted legacy automaker surviving on government incentives magically out-earn inflation for 10 straight years. But like the stretch buyer's thesis is Bitcoin goes up, yield goes up, Saylor keeps stacking. Bitcoin doesn't catch fire.
Yeah, Bitcoin. It's as simple as that. Bitcoin doesn't catch fire. There's just way less risk associated with the whole thing. And then you think about. I sent this to Jeff Park. The companies that are offering this good credit are going to start being a lot more attractive to anybody buying bonds. So people are going to sell the bad junk and buy the good stuff because it's so much better on a risk-adjusted basis everywhere. And at that point, it kind of cleanses the market. Like these Bitcoin credit companies like Strategy and these other Bitcoin treasury companies that are offering good credit instruments to the market are cleansing. They will cleanse the market by removing bad businesses' ability to access debt capital markets. And I think that's a really interesting concept to think about. It's like Bitcoin fixed the money. Okay, how does Bitcoin fix the credit market? So it's like you need counterparties that are so incredibly trustworthy with so much collateral that they create instruments that are so much better than the rest of the market that you can't not hold them.
But you've still got the liquidity problem. They got to be able to sell the bad stuff to get to the good stuff.
You got to be able to sell the bad stuff.
And some of these people might be riding those bonds until 2097 when someone's going to have to collect on that.
Damn, bag holding for 70 years.
That's such a good point, Ben. And that's why this is going to take a decade. That's why it's going to take 20 years, because all this stuff, all the bad stuff has to turn over. And anybody that's sitting on that 2097 bond, like you're going to have to take Ford to court to go get your assets. Or like if it's secured, if it's unsecured and backed by heirs, as Soleil mentioned earlier, you're kind of screwed. But like there's going to be illegal proceedings. Do you go through that whole process? Do you just mark it as zero? There's the next 5 to 10 years, and watching this disruption take place in the market is going to be totally fascinating. And this is just one place, right? This is one company, and why I think we'll have a segment on this every week, because it's totally fascinating to think about the entire debt structure of the market that was historically incredibly opaque. I came for the Bitcoin and I stayed for the bonds, and that's where I'm at.
It would be really interesting to find the holders of those 2097 bonds and see what types of holders they are. So add that to the list for the future.
Yeah, the type
We've got
of
the fancy
holders.
terminal, so
Maybe we'll get you one. I think you need one too. Yeah, this stuff is totally crazy. Shall we shift gears? What do you think? Have we hit the dead? Have we killed the dead horse?
Mm-hmm.
Yes.
poor Ford.
Well, I just think that you got to remember too that they were the only one of the big three automakers that skipped the TARP bailout in 2008. I don't know if you remember that. And then the next year they got $6 billion from the Department of Energy. So really, like, those Ford bonds are betting that your government's going to be solvent in the first place. It's just a total mess. It's ridiculous.
And that's just a money printing solution. Yeah. Wow.
Yeah, I think the best thing I can say about Ford is that they're going to go bankrupt last.
It's just so critical to the American world, the American economy. Yeah. The other thing we were talking about was these bailouts, which I think is, Mike, you hit on this a little bit earlier. All of these bailouts, like these, what's Jeff Park call them? He calls them Scrabble tiles, right? The TARP and all these different bailouts are just different forms of money printing in a different way. You think of like Silicon Valley Bank, and like Silicon Valley Bank was a money printing moment. There was a bank run on the bank in Silicon Valley. All of the tech companies banked there. That specific bank, Silicon Valley Bank, they made, if you wanted to get a line of credit from Silicon Valley Bank, and they had the best rates, you had to keep all of your money there. You couldn't like split up your exposure between other banks. So they made all of these tech companies put all of their money there. And then when the tech companies went to actually go get the money, there's no money left. It was like a huge issue. And what's the US government going to do? Are you going to let your best, sector in the entire like world just fall to pieces because of one bad bank in Silicon Valley that took on too much risk? No. They said all of your deposits will be insured, which is just a super, 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 super slippery slope of just, we're going to money print no matter what. Like it's the incentives are really not great for banks to not take on risk. Like all of these banks are taking on risk because they know if there's just too systemically important, they're going to print their way out of it. Then that's why we buy Bitcoin. That's why we hold Bitcoin, because these incentives are just totally skewed. And the way out of poor risk management is money printing. So it's a crazy world out there. And maybe we'll hit on Target too a little bit, because you brought that up, Adam. I got a little bit roasted in the community. Some people are like, oh yeah, screw Target, it's the worst place ever. Some people are like, have you ever been to a Target? You should go walk in a Target. And then it became a moment of contention with my wife. She's like, well, all right, we're going to Target. We're going to go check this out. And it's difficult, right? In nice places, Target looks like it's doing fine, but in bad places, like everything in the area is like locked up. You can't go get shampoo or toothbrushes or like medicine. It's like, why would I even go to Target? Like the Target in Seattle was horrible. We used to go to Target because it was kind of cool. Like you get some stuff for your house, and like you get all the toiletries and stuff that you need. Is like just a trip that you did every once in a while. And then it's just like, why would I ever do this? Like I have to ring a bell every time I wanted to go like get anything from the shelves. And then you've got a minimum wage employee that comes running and or walking, maybe, or doesn't come at all. And you're like, this shopping experience is completely horrible. But then you're like, well, what's the point of Target existing if like I could just go get all this stuff on Amazon, which is what I do now. I subscribe and save.
That's the friction, right?
Yeah.
I mean, like, you go to those stores and it shuts you off immediately. You go, why am I going to come here, jump through all these hoops? There's too much friction out there. But also, if you are Target, you have to look at a lot of those stores now and in those areas and go, do I even want to be open here?
That's
right?
exactly
when you had all of the people that could just come in and just walk out with, as long as it was less than $1,000 of goods or whatever, and they're clearing the shelves. If you're a corporation that's trying to make money in a world where that's getting harder and harder for some of these, you've got a serious risk return that you've got to look at on that. And most of them start to vacate those areas. So now those areas have far less options to them. And you basically get down to well, I guess Amazon will bring it, hopefully, unless people start raiding the trucks and stuff.
That's exactly
So-
what it is. Like there's something called shortage percentage, which is just a percentage of your annual sales that you'd expect to lose due to theft, and retail theft is horrible across the industry. And it was like very regular to see like a 2%, 3% shortage rate where like $2 to $3 million of your product is missing every year, which is crazy to think about.
Jesus.
And then, on top of it, multiple years ago, back in like 2019, before the pandemic, Target kind of pivoted their strategy where they want to compete with Amazon. They fulfill online orders through their stores. And then obviously as e-commerce takes off, the infrastructure just isn't there. The logistics aren't there to compete with Amazon, with Walmart on that basis. So they're just in an identity crisis. So much risk everywhere, man. I wish I could talk about this for hours, but yeah, it's a tough spot to be in.
Identity crisis.
Yeah, they don't want to know.
Yeah.
They're trying to understand who they can be.
Yeah.
Like, do we compete with Amazon, or do we just downsize? Like Ben said, we have all these stores that we probably need to close due to these operational issues.
Yeah.
It's a tough spot. You need to decide to win on one thing, and then it's really hard to compete. It's a super tough industry.
Yeah, it's like identity risk. I haven't really thought about that before. It's like you can't find your little niche anymore because it's been taken by these large companies that can move faster, quicker, with less friction. And it kind of makes you wonder, like, what's the future of the world look like if a company like Target disappears and a few of these other, like, I get they've got all the real estate, so you've got some assets there, but then the question is like, who wants the real estate?
When's the last time any of you were at a mall?
Right. I've walked through an empty one.
You remember when you were a kid and like that was the spot. You were always there, right? You'd go there to
Mhm.
shop for everything. Now they're empty.
Right.
We have a massive one that they put in here a couple of years ago. And you walk in there now, and I think there's probably 6 or 7 active stores in there, and the rest of it's just completely vacant. Like that model just got decimated as soon as Amazon came, and people could take the friction of going to the mall out of their lives. They didn't need to anymore. You can ship it to your house. You don't like it, you can ship it back. Right? It's an easy transaction now. World's getting lazy. We don't want to leave and have to go chase things down. That's just a reality now.
I don't
Go
know
ahead,
if it's
Mike.
the world got lazy. I'll say it differently. We'll move on to the next topic.
It's not lazy, but
Yeah, no, but,
we've gotten more efficient in our lives, and we're
Exactly. It becomes ease
constantly
of use.
juggling things. Yeah.
So when we talked about the black swan events, you could talk about things that happened due to there's a mistake in the system. But in Silicon Valley, I've been here for 25 years. What happens is there's a term that's been here ever since I've been here called creative destruction. So the company Netflix put Blockbuster out of business. The easiest one, Amazon put Sears out of business, right? And so with that, and then you have Google puts Yahoo out of business. So it's really great for the creative company, not for the company that gets destroyed. But now with Target, with Amazon making it so easy to get this, the other black swan event is a technological event that we talked about, Ford, and Tesla versus Ford. So I think we see that also as black swan events, just technology putting you you have an inefficient business to compete against, Amazon. I mean, Adam, if you're at Target, nobody there wants to talk about competing against Amazon. That's probably the worst story to talk about, right?
Yeah, 100%. Absolutely.
Yeah, and think about if you're a Target executive, every day you got to go to work, figure out, how do I compete with Amazon? They have Prime delivery, a subscription. I get free movies, and they don't have a shrinkage problem, and it delivers to my house, and it remembers what as Jeff said, he has a subscription for toothpaste.
And like, what are you going to do? Like, what's the incentive to work there too? Like the equity upside in Target.
Exactly.
Like that's not cool. That's not sexy. Like, good luck trying to hire people. Like, does anybody like grow up, man? I want to be.
Your RSUs and Target stock are down, 70% over the last 3 years. So think of all the people that have spent their career there, just banking on $1 million of RSUs that will go down to $250,000 in, a short time. It's a really sad thing.
Yeah. And then, what's wild is, so before you had telephones in your house with a wire, analog, and then I was in Silicon Valley. So what happened was we were displacing with voice over IP. Cisco was displacing all that with phones that did voice over IP. The problem that happened was that once the iPhone came out and the cell phones went to unlimited pricing per minute, people were like, I don't really ever use my desk phone, because then they started with WebEx, which led to Zoom and Skype and so forth. So from that perspective, the whole VoIP play became a non-starter, even though it was better technology, because once your cell phone went to unlimited minutes, you didn't give a crap what the technology was, because the economics were better. And so you're trying to pitch, and that's where you get back to, I don't want to spend millions of dollars on a phone system if nobody's going to use it. I'll just use my laptop. And so I've seen analog lines, and then I saw VoIP to get pitched, and then it got displaced by the iPhone, and that all happened. So, and that's in a very short period of time.
Very short. Maybe we switch gears because we got, I don't know, 15 minutes left, and I mean, maybe we'll go a little bit over because we're cruising here. If we could talk about this stuff forever, and I'm sure we will talk about this more. But Grain, you were just in Argentina, and I think we should give this. I think we should give this some air, because this is a really interesting story. Argentina, obviously, big monetary issue. New president came in, Javier Milei. It was a big ordeal. He's like getting rid of all these government enterprises, afuera, and then it was like involved in some scams, and now the country hates him, and it's a bit crazy down there. But and everybody thought he was going to be the Bitcoin hero and put the company on a Bitcoin, or the country on a Bitcoin standard, like El Salvador. Ended up not really happening. Launched a meme coin, did the whole thing. But anyway, Grain, you were down there and you traveled and you experienced the money, and you went to like car dealerships and stuff. Tell us a story. I think.
Sure. So first off, in my first job in New York City in 2000, I went to Venezuela, and so it was the Bolivar at that point. It's still the Bolivar, and what I found out by asking people from Venezuela to this day, they've run out of zeros 3 times. So the Bolivar, there's been more, but since I was there's been 3 generations of the Bolivar, because they keep on printing zeros onto it. The paper's not big enough. That's Venezuela. I was in Caracas and Maracaibo. So that was the old days. That was 1992, 93. So then on this trip, I went to go to Patagonia. And so I was like, cool. So I take a plane, SFO to Houston to Buenos Aires. When I travel, I take $500 in cash. I have credit cards, because you got to pay tips and stuff. So I'm in the airport in Buenos Aires, and you have to give them your passport. It's Bank of Argentina in the airport. And I figure I'll go there. First, I tried taking it out of the ATM machine, and they only let you take out 60,000 pesos, which is equal to about $48. And I'm like, I think I need more money, because there's a limit on it. So I go to the desk and I give the guy $200. He's going to give me like 250,000 pesos. And I'm like, cool. And I've got a flight. I'm going to go to Tierra del Fuego, Ushuaia, and then I'm going to go to Chile. So because the guy knows I'm an American, I said, can I have some Chilean money, whatever it's called? And he's like, no. I'm like, why not? He goes, because we don't have any. I'm like, you got euros, you got francs, you got yen, you don't have Chile money. It's the next door neighbor. It's like, no. So I take my Argentine pesos, go to Ushuaia. So then I drive over into Chile, and I get there, and I get to the hotel. This is a very, very nice hotel. It's about $200 American to stay at this hotel. So I go to the front desk, and I said, look, I don't have any Chilean money. And the guy's like, okay. I'm like, because sometimes they'll change it for you at the hotel. And he's like, you got to go to the black market to go get it. I'm like, what? And so I said, what am I going to do? And he's like, well, what do you need? I go, look, I got like 100. I got I didn't tell him I had $500. I have $100 bill. He's like, that's no problem. What do you want? I go, I want singles and fives. So he gives me back $100 in cash. He had a wad of US dollars. And he goes, everybody here prefers the blue dollars. I'm like, what the fuck is a blue dollar? And that's American money, because they call it blue. I don't know. So I'm paying everybody. And the Chilean people don't even want the Chilean peso. That's how bad it is. Anyway, I get back to Buenos Aires. People are beautiful. They're dressed great. All of the restaurants and cafes are packed. They start at 4 o'clock at the cafes. They have their cappuccino, their coffee, espresso, whatever it is. Fabulous. The restaurants, everybody goes to dinner at 9 o'clock at night. The restaurants are full. The weirdest thing is all of the malls that I went to in Buenos Aires, right? And I guess all the nice areas, whatever, I walked around, all of the malls were completely full. There was not a single empty storefront. And all of the inventory was stacked up in every single store. And I'm like, if they got bad currency and they're doing all kinds of renovations on the real estate, I don't get it. So I went into the car dealership because I like cars. If you want to buy a car, you got to buy it in American dollars. You can't buy it in Argentine pesos. So I learned that. That was interesting. And then what happened was, what it said was that if you want to, breaking out a little Coke here, real deal.
Glass bottles are the best.
Last bottle.
Yes. So with that said, to wrap up, the real estate was all being renovated. And I'm like, why is the real estate being renovated if the money's so bad? That's their store of value. And once you own an apartment, you can live in it for whatever, 50 years.
Forever.
So they have this really good renovation of real estate. That's the store of value. It goes up. And then you don't have to worry about the debasement of the money because you bought it for cash. So, and the reason why the stores are all stocked with inventory is because it's a hard asset. It's inventory. Excuse me.
Yeah, it's crazy that these other countries that have really bad currency rely on US dollars as their stable currency when we're over here in the US and we don't even want the currency. And it's like, it's crazy.
Final boss of currency collapse.
Yeah, it's the final boss. Like once all these other countries realize that our currency isn't stable, then what?
But it's better than theirs. So it's a game.
It's better than theirs.
What's better than theirs? And what I could tell you is that I thought it was going to be, I thought Caracas in 92 was, I mean, again, it's like the old days. I have not been there since then. That city was pretty worn out at the time I was there. But Buenos Aires was beautiful and modern and beautiful glass buildings and old architecture. It truly is the Paris of South America. And it was awesome. They had a very efficient, the train station was gorgeous. That's where I stayed, right by it. And so I did not get the sense that anybody, and I asked ChatGPT, I'm like, why aren't the people concerned about this? They're not, because they've been living like this for 40 years. Buy your house for cash. You don't have to worry about your biggest expense, your rent. And then the reason why you can only take out 60,000 pesos at a time is to keep the velocity of money fast. But it doesn't matter. Most stores, I'd say 90% of people paid by credit card anyway. So I just like to have cash because I tip bellhops or whatever, or people. So anyway, so to me, it was a big eye opener going there because for a third world country, it was awesome. The other thing I'm going to say is that WhatsApp for a telephone call works better in Argentina on a free Wi-Fi at a coffee store than my phone works with AT&T in Silicon Valley. And that just bugs the crap out. Or making a phone call through X or a phone call through whatever app I had on free Wi-Fi worked better than a cell phone call in America. So that just irks me to hell. And that's a great answer right there from Elliot. They save in the dollar because the dollar is like Bitcoin to us. And so I only saw one place that advertised Bitcoin, but it was an eye opener. And I thought it was going to be a lot worse. And I was really, really surprised. So
I read this article on the Federal Reserve's website today. It came out in July and it's called The International Role of the US Dollar 2025 edition. And I highly recommend it because it's from the Federal Reserve, the people with the biggest incentive to make sure that the dollar looks good. And it is filled with very easy to read graphs that not only show the death of our dollar, but the world's eroding trust in it. And it is just mind-boggling that this is coming from the Federal Reserve, and they're trying to dress it up the best that they can. And you're just seeing like foreign exchange reserves of the dollar are down 20%, foreign holdings of treasuries down 30%, and they're trying to put on a face. So I think the rest of the world's going to catch on.
They're trying to pump their stock.
Yeah, I'm going to pivot real fast. JP
Rug
Morgan
pull.
put out this. Yeah, JP Morgan put out this article called the or investment thesis called the debasement trade. The fact that it has the correct name is awesome. And basically the core thesis is that gold and Bitcoin are complements to swelling government deficits. We've all known this. If you've been in Bitcoin, you've known this based upon the years you've been in it. So that has been true, this debasement trade. Now, one of the reasons why I like the term debasement is because there's two things going on with Bitcoin. CPI, Consumer Price Index, which the price of something can go up because there's a supply chain problem. That's not money printing. Money printing is you have a fiscal deficit. In the US, it's $1 trillion a year, and it's about 6.5%. So you add the debasement of the currency, that's M2, plus the CPI, and you get whatever, 6.5 plus 3, you got 9.5. Round it to 10%. That means every 7.2 years, your buying power gets cut in half. China's M2 is 10% a year. I don't know what the CPI is there, but it's probably more than 2%. So the takeaway for this is the debasement trade is JP Morgan said in order for Bitcoin, they said gold leads Bitcoin. And in order for it to catch up, it'd have to be 40% higher or 165,000. So, congratulations to JP Morgan. You now know something that we've all known for anywhere from 1 to 10 to 15 years.
Here is the debasement trade visualized. The blue line is the CPI, Consumer Price Index, so the increasing cost of goods. And then the red line is the M2 Money Supply Index. So it's how much the money supply has increased. So the spread between the two is the debasement. That's the debasement trade. And it doesn't look like it's stopping. This is from 2005 to 2025. The compound annual growth rate of the M2 is like 6.5%, and the compound annual growth rate of the CPI is like 3.5%. And within that, the CPI has also had changes to the construction of the index itself, whereas like breakfast foods used to include eggs and bacon and like those types of normal breakfast foods. And now I think breakfast food is just cereal. Obviously, those are very different. The price of those changing over time is incredibly different. So yeah, it's wild to see that the Fed is posting this information, and then so is JP Morgan, understanding what's going on. One of the big things kind of tying this back to like credit quality. So what's the credit quality of the US government?
Just got downgraded by Moody's.
It did, but like what's that mean?
Oh, damn.
Who they pay the debt to? Who they owe the debt to? What is the debt? Like, what happens if they don't pay the debt?
It's the best of the worst, right? I mean, you look across the world, I guess your credit quality is relative to everything else that's out there. And if the rest of the world is spinning out of control faster than the US, the US is still almost the best you got. But man, it's getting dark out there when you start watching this, because we're hitting this weird point in time where everything's just accelerating, and it's accelerating so fast. And you start looking, I used to always be mesmerized watching that debt clock just climb and climb and climb. And, it doesn't feel real until you start tracking the impacts with like those charts that you just showed as well. Like that's a terrifying chart, watching how fast that debasement's accelerating away from even CPI. Because I think what it tells you when you look at our economy is that the economy is slowing down and they're trying to find a way to re-inject it. And now all of a sudden you've got all this productivity that's coming out of the market when all these people are aging out of the workforce, and they got to find ways to replace that because you've got all these systems and entitlements built up that you got to be able to fund. And so I think what you're seeing right now is the last ditch effort to try to make an impact on that, because they don't have that long to turn it around. Yeah, it's
absolutely. So this is I took this picture December 12th, 2023. So this is 2 years ago. 32.9 billion. I was in New York for work, and I was like really bullish on Bitcoin at that point in time. And then Jim Cramer posted this, I don't know, like 10 days ago. Our national debt, 37.6 trillion. I'm like, oh my God, this is like, I went back when he posted that. I was like, oh my God, that's so much money, right? That's so much money in such a short time period. Like it's greater than an NVIDIA. It's 1.2 NVIDIA just out of thin air. Like,
well, the worst part about this is that the third line item in the federal budget is the interest on the debt. So that makes things worse. And so let's try and wrap this up on a positive note. Look, for the 33,000 people watching this, you're aware of now of what's going on. And Tim, Justin, people that we both know, we were in New York City, and he said, can you orange pill a friend? And I said, sure. And this is at PubKey. And I went to go talk to him. Very smart guy, works at a bank. And I said, what's inflation? He's like 3%. I'm like, okay, what's the M2 number? I said 6.5. I just tell it to him over the past 25 years. I go, well, you add those two together. So 6.5 plus 3 is 9.5. Just round it to 10% because the rule is 72. That means every 7.2 years, your buying power gets cut in half. And he goes like this. He looks at me, he goes, you add them together? I'm like, well, yeah, it's a yearly rate for both of them. He goes, I never thought of adding them together. But he really didn't know what the M2 number was. And so that's why, when it's the younger generation, look, I'm the old guy here. I already know that. So what does that mean for the young people? The reason why it's harder is because you're getting paid, but the money buys half as much every 7 years, right? So you're 21 years old. Before you're 30, your buying power is cut in half.
yeah.
So and then Jerome Powell said in front of Congress, anybody can fact check me. He said, well, we don't look at M2 because it's obsolete. We learned it in college. There's no reason to talk about it. And I'm like, what are you talking about? It's obsolete.
It's so crazy because all of that extra money printing is going in new assets that never existed before too. So not only is it like all assets are printing, you've got actually new assets with crypto that are just absorbing all of this, and it's exacerbating the issue. Right.
But what made it worse? One of the craziest things that happened during COVID was the biggest jump for Robinhood. So all of a sudden you're at home, you can't spend money, you're wearing a mask, right? Life sucks, and you're sitting at home. You're like, well, I could bet on sports, or I could buy freaking crypto stocks. It was 2020, the halving happened, the price dropped down. March of 2020 was the bottom. So then you hit the halving, you're like, well, Bitcoin got killed. Let's just start buying stocks for free on Robinhood. Robinhood runs all the way up, right? Wasn't there a company called GameStop that had a gamma squeeze in January of 21? Yeah. So then this happens and everybody's sitting at home and Robinhood goes bananas because everybody can't. So the government prints money, but the problem was you couldn't spend it because your store was closed. So now you're sitting at home waiting for the Amazon guy to show up. Hopefully he doesn't give you COVID.
Yeah.
So this is
YOLOing assets. YOLOing assets because it's what makes sense. All right, we're 2 hours in. I know we could probably take this 5 hours if we wanted to. I'm gonna pass it around. We'll do final thoughts just to wrap it up, and we'll go from there. Adam, super appreciative of you joining. Thanks for chiming in. I really appreciate your perspective, and hopefully we'll have you back and get on. Start doing a couple more offshoots of True North.
Of course. Anytime. I love
chats.
talking about this stuff. Like you said, I could go another 5 hours, man. This is what you're the only people that I can talk to about this stuff. My fiance is asleep in the other room. She has no idea what's going on to the magnitude that it is. So by all means, anytime.
Yeah, absolutely. So maybe we'll pass it over to Mike. Mike, we'll give you final thoughts and we'll go around. Mike, that's you. Grain of salt.
Oh,
I called you Mike. I guess I called you by your name.
No,
sorry.
I have my name in there. I like how I'm pointing to my name over here. Anyway. Hey, look, everybody. I think that you know what you have to think about where you want to be in 1 year down the road, 2 year down the road, 3 year down, whatever it is, and then you make your decisions and do that. And when I realized that Bitcoin in 2017 was like, oh, I think this is going to be the best thing ever. I jumped into it full force. And now because I always thought in the future, why wouldn't I want to buy as much of it as I could? So that's where it happened. And I know Tim for a long time. And you know what, guys, this has been great. And I could talk about this all the time, but go out there and go talk to people, see how people are running their businesses, see what's affecting them. And you learn more by going out there in the real world. I think that's great. Thank you.
See risk everywhere, and then go experience in different places. Like your experience in Argentina and Chile, like that story deserves air. You need to, that's interesting to tell people everywhere. Like, this is real life things that are happening in the rest of the world. 100%. Keep doing it. I love the travels of grain of salt. Great. Over Soleil.
Yeah. So my final thoughts is actually a question for Adam. So we'll call it final rants. So with your following, which is well deserved, by the way, with the content that you pump out, you could have just covered the knots versus core debate in a neutral way, so as not to anger followers or whatnot. But they say that Bitcoin is a courage test, not an IQ test. And there's definitely some high IQ, proponents out there for core. But, I just wanted to know, what gave you the courage and conviction to take a side and endorse knots?
Yeah, well, I tried to give a neutral overview of it for Swan, actually, and I got raked over the coals because I learned that you can't do a neutral overview of the debate. You need to pick a side in this thing. So I learned that the hard way. But nothing too crazy, man. I love Bitcoin and what it can do for humanity, and I haven't successfully seen the case as to why we should change the 80-byte op return limit, that enables more flexible data embedding. I've seen the case that filters don't work, in the sense that you can't ever completely prevent unwanted data from being included in the blockchain. But, the entire thing is a game of incentives. I view it as just, opening up some attack vector that totally is unnecessary. I like how you actually framed it as Pascal's wager on X. I thought that was brilliant. I love Bitcoin, and I want to keep Bitcoin how it has been since 2014. I want to have Bitcoin the way I have grown up to like it.
Yeah, man, I love it. I appreciate you, trying to keep Bitcoin money. And I guess my final thoughts would be a message to the core developers. Game theory of cooperation says that the optimal strategy is to cooperate until someone defects against you. And then you defect, back against them until they stop defecting and they start cooperating again. So I would say that the rise in the knots node runners shows that the network recognizes that you have defected against Bitcoin. And if you want us to stop defecting against you, all you got to do is stop defecting against us. And that's it.
That is deep game theory. So Soleil, just have game theory episodes. Just go through that. That's awesome.
There we go.
100%. Defect. All right, over to you, Ben.
Yeah, no, I've really enjoyed this conversation. I think that these are going to be interesting ones to continue to have. And I would just continue to challenge people to think through the concepts of money and credit and think about what this means in a future world where Bitcoin becomes viewed as money, effectively the final settlement, right? If you just think about credit as the promise of money in the future, think about what that means as Bitcoin grows and scales. And if there's a world in the future where Bitcoin shifts from the store of value into being recognized globally as the money, what does that mean for a currency like the US dollar? So just think on that for a little bit. It's an interesting thought experiment. I've been going down that rabbit hole here for a little bit.
Everything's being rewritten. It's all new. So it's okay if it's uncomfortable. And it's okay to be wrong. And it's okay to be think about what the future can be. All of this is completely new. Everything's novel. So if you think you've got a weird thought or a stupid thought, it's not a stupid thought, because we're pioneering a new land.
And the last thing I would say is, when everyone's screaming, start looking for the risk returns,
the opportunities,
risk reward payoffs, right? Tune out noise. Go out there and find the opportunities. If people are screaming, it means those opportunities are available. So be willing to do the due diligence. That's your edge, right? Don't sit on your hands. Don't take the word of anybody else. Go do your due diligence, understand what you're buying into, and search for those opportunities that everyone else is going to overlook while they're scared.
Absolutely. Don't rent your conviction. Tim, over to you.
I mean, you guys are just nailing point after point after point tonight. I guess on the everything is being rewritten part, I've had the opportunity recently to just kind of, between Ed, myself, and some other guys, just like really have a lot of conversations, like meeting after meeting after meeting. And the guys on Wall Street that are actually willing to have a genuine conversation with you, they'll ask you like, well, how do we get our mNAV back up for this company? Like, what's the strategy? And it's like, that's how early we are. Like, it sounds hyperbolic in the language when you're like, we're birthing this new industry, but like, that's exactly what's happening. I mean, I have the pleasure of talking to almost everybody, and it's just like, holy crap, we're really early. And like just
Still,
thinking about pristine collateral, the best money, credit, like all of these concepts are just going to evolve, and whoever can kind of figure out, which is everybody in this community right now together, like whoever can figure out like the next best thing to do, whether it's M&A or whether it's structuring something a little bit differently. I think we're just going to look back and be like, oh, wow, you were in the Bitcoin treasury industry before the year 2030. Like you were there at the beginning. And it's like, we're still
it's
in
like the internet. Yeah. Yeah. In hindsight, it's going to be so obvious.
Yeah.
So obvious.
So super, super cool times. Mike, it sounded like you wanted to say something.
I just agree with you. I agree wholeheartedly. You know, you're going to look back in 4 or 5 years and say, why didn't I do more to learn more about Bitcoin treasuries? If Bitcoin's good for a person, it's good for a company. If it's good for a company, it's good for a sovereign nation. And so that, you know, I think you will look back years later and see where it is. And you'll be like, wow, the whole industry turned around. I'm dedicated to the space. I'm going to be in, this is my second career, and I'll be in it for the next, you know, I don't know, for as long as I work.
As long as you're having fun.
Yeah.
Yeah. Over to you, Adam.
Yeah, it's tough to pick on something to end on. We've had such great discussion tonight, so thanks, guys. But I guess I'll say in the age of great uncertainty that we live in, with AI disrupting entire industries, our entire economy, and you know, the money printer continuing to go debasing our currency, just know that because the debt needs to be devalued, the asset owners are going to be disproportionately affected to the upside. Therefore, you need to own assets in this day and age. And thank God for Bitcoin, because it's going to shield you a lot from the destabilizing effects of both the money printer and any AI disruption. So don't want to end on a downer, but thank God for Bitcoin, because that is the positive note.
Yeah, absolutely. Thanks for being here, Adam. Appreciate the perspective as always. Keep doing you. And you found a lane, and it's so awesome to see. So like,
thanks, man.
Yeah, keep doing it. Because this lifts the education level for everybody. Like, we all communicate to different people. We all have different audiences, and cross collaborating and talking to different audiences is good for everybody. Like, this is clearly a huge education gap, and we've got to lift up the finance knowledge of like the rest of the world in order to get to a relatively decent baseline. And that's a complicated task, and it takes different perspectives and different communication styles. And yeah, it's not everybody wants to listen to a 2-hour and 15-minute podcast of 6 dudes talking on a, you know, Wednesday night at midnight Eastern, right? Like you've figured out the
they'll listen to a cokehead rant at 6 a.m. though.
Yeah, exactly. Yeah, it's just such an exciting time. I encourage everybody to just talk about this stuff. Again, communication's huge, education's huge. We're going to try to continue to push this education kind of lens into the market, just because there's so much I'm learning continuously every day, and I've worked in finance for 11 years. And if I could fast track that learning to everybody else and like what I'm seeing, that's the ultimate goal. This is really a benevolent journey, and I want the world to be a better place. So I'm
Tell
really
the people you care about Bitcoin. You might be the conversation that saves their financial future. Make it happen.
Okay, one last sec. You know, maybe you buy more Bitcoin for your friends and family that don't. Maybe be a little bit altruistic in the future. If you can't convince them, buy enough for you, buy as much as you can. And then in the future, you help somebody out and you're like, look, I can help you. How can you do that? Well, I bought Bitcoin in the past. How much? I bought enough. And then that's what you do. 8 years in the future, you go help somebody.
So
Or maybe loan it to them at a very attractive interest rate.
bingo. Be the one company that does that. Every Christmas, I'm at the age that all my friends are having kids, and every Christmas I buy each one of my friends' kids $250 in Bitcoin, and I put it in a wallet for them. I custody for them, the whole thing. And so now, like, some of them that are 4 years old, and it's like looking pretty good. I'm like, this is a college fund here for your kids. And the same thing. It's like they weren't going to do it. They have some like MSTR exposure because they know I like talk about it and they want to support me, but that's really it. And it is a nice feeling to do that for people. So absolutely encourage that. It's cool to see. And my last thought is that I came for the Bitcoin and I stayed to disrupt the bond market, and I'm going to be working in this space for a long time. So you can yell at me all you want. I don't really care. I'm going to be working here for a while. Cheers. Thanks everybody for joining. 2 hours and 15 in. I think we got like 35,000 people. We will catch you next time, maybe next week, maybe after that. We'll see you later. Peace.